Hey, welcome back to Everything Money. We're so happy you joined us again. Thanks for watching. As always, patrons all over the world, you know I love you and appreciate your support. I hope you're loving the software we're giving you. Today we're talking about Intel, one of the best companies around, Paul. You love Intel. It's a corporation technology company headquartered in Santa Clara, California, Silicon Valley. It's been around for a long time. They do a ton of money.
Santa Clara, isn't that in Mexico?
Probably. Why do you love, Paul, why do you love Intel so much?
So you said something just now. You said, Paul, you think it's an incredible company. I never said that. This is exactly what I would talk about. Difference between the company and the stock. They're very different things. I do think Intel's a great company. I think they make great chips. However, I love the stock price and the valuations attached to it. And that's why, if Intel was quadruple the price right now, I would say I hate Intel stock.
I see.
Right?
Much like our take on Tesla. We drive the cars, hate the stock.
You drive the cars, yes. But Mo did order his Tesla Model S.
Yeah, and then this expected return for that car will be 3 years from now, Paul. Mo, so congratulations
that's
on
correct.
that.
Thank you.
Yep. It's already for sale, actually.
It's already on Auto Trader if you want to go buy it.
Go ahead, Paul. Tell what we're going to do, folks, in this video is use our world
famous.
Our world famous.
Warren Buffett actually mentioned our eight-pillar analysis at his annual meeting. Don't quote me on that one, but somebody told me who was there.
Yeah, we are going to use our infamous, world famous 8-pillar analysis. I can hardly do the damn show, Paul. 8-pillar analysis to analyze Intel and why we love it as a company and potentially at a stock price, Paul. Go ahead, my friend.
Actually, had Intel pulled up right here. Okay, so one thing I want to talk about first off, guys, when people tell you that stocks won't go down a ton, this is Intel back in 2000. You could not find a single person in the world who in 2000 thought Intel was going to go down in price. And look what happened to it. It isn't even at its peak from 20 years ago, all right? Everybody loved Intel here. Everybody hated Intel here. I want you to keep that in mind. Everybody loved it here. Everybody hated it here.
This kind of looks like the Bitcoin price chart of the last 3 years.
It actually looks like how people view me in this world. Like, oh, they love me, and then they watch our videos, and I say mean things, and all of a sudden they hate me.
Yeah, okay.
But that's when things go better.
But you're growing on people. Go ahead.
I'm growing on people. So this is very important because everybody loves certain things these days. Electric vehicles, cryptocurrencies. When things are loved in the markets, it's usually at the wrong time. So let's go back. Let's go through this. $230 billion market cap. 12.4 PE, check mark there, and very healthy margins, 24%, check mark there.
Wow.
What I like also, Uncle Seth, good dividend, 2.5%, 2.3%, 5.4 billion. Now remember, those people who are new here, dividends are not always secure. Companies will lure you in with a dividend and borrow money to pay it just to get you excited as an investor because they realize all you care about is looking at that dividend yield and you think it's there. We have to look at the free cash flow to make sure it can support the dividend every year.
You lure MILFs into your Porsche with free candy and Chardonnay.
I do.
Pillar number 3 that we always love looking at is revenue growth over the past 5 years, Paul.
Okay, revenue growth of 60.5 billion to 77.7. Check mark. People are saying Intel is dead. I'm looking at the revenue and saying it's not dead. Now, there might have been acquisitions along the way here, so you want to check into that. That's 30% growth. Make sure that when you're analyzing a company you sit there and realize that growth can happen through acquisitions. That's not the same as organic growth. So you want to make sure you differentiate between the two because you should not equate growth from acquisitions to be the same as growth from organic sales. So still a check mark because that's the point of our show. Net income, look at this, guys. 11.23 to 18.6, check mark there, which is down from the previous year, but that's fine.
4 straight checks?
Shares outstanding.
Let's do it.
4.72 billion down to 4.06, check mark there. So they're buying their shares back with their extra cash flow, which is a very good thing when stocks are selling at a low PE, and the company uses their cash flow to buy back shares. They are investing their money at a good rate of return. They're also saving that dividend yield of 2.35%. They don't have to pay that on shares that they retire by buying back. And they're putting their money into an underpriced asset, which is what you want them to do. That is good capital allocation. Yep. Okay, now guys, this is our software.
Yeah, what Paul is showing behind him, this is the Everything Money software. As a part of our Patreon, if you've ever wanted to be a patron member, this is the channel to grab onto. Other channels out there literally give you a single Zoom chat for $20 a month with 10,000 people in it, you get personal access to this software where you can look up any company. Paul, show them around a bit for just 30 seconds.
So we're going to look at Intel here. Actually, I'm going to go to a different stock. That way I don't give away the Intel pillars. But one thing we have is a great retirement calculator right here. We're going to put a real estate calculator in. We're going to have a lot of different calculators here. But so if you want to find something like, hey, show me the popular list of healthcare. Boom, healthcare stocks. And it's just going to load up tons of healthcare stocks. You can look at them, see how they're doing. That's one thing you can do here. You can go to look for a specific company, Microsoft. Here's the great thing, guys. It'll give you your income statements, your balance sheets, your cash flow statements, and then the total 8 pillars. Tell you which ones are checks, which ones are X's. It does all the work for you. So it's only 80 cents a day right now. It's only going up in price. The software is only getting better. You have to decide if that's worth it to you for 80 cents a day. All you guys go spend $74 a day on Starbucks coffee. So this is literally 1% of that cost.
You also get access to the Discord channel where you can talk to other people all over the world about these companies. So keep going, Paul.
All right, so balance sheet.
Yep, balance sheet. This is current assets over current liabilities.
46 billion versus 24 billion. Check mark there. They've got over $20 billion in excess cash. Now for the big mamma jamma, the cash flow statement.
Cash flow, free cash flow.
So free cash flow is cash from operations less your capital expenditures, okay? You use that money to pay your dividends, buy back shares, pay down debt, make acquisitions, things like that. So I look at free cash flow more than I look at earnings, net income, because net income is manipulated, not on purpose, but the government, IRS rules, SEC rules. Free cash flow, though, is harder to manipulate. It's still able to be manipulated, but it's harder. So I added a line to our free cash flow statement because I want to make it easy for you. Free cash flow. 11.4 to 19.2, check mark, and the average over the last 5 years is 15. 15 times 20 is $300 billion.
Oh, the actual market cap is $230 billion.
Okay, now, here's the difference. Their free cash flow, as you can see, is increasing every year. If you want to use 15 times the last year's free cash flow, if you think this free cash flow is stable and going to either stay the same or go up little by little over time, 15 times, which is a reasonable amount, times 19 billion is $285 billion. So it's still selling for less than last year's free cash flow. So what I want to do is, I want to sit here and look at the 8 pillars. Look at this, guys.
Oh boy.
All 8 checks. Okay. I love this. Now, what are the issues with Intel? Okay. Before we do our stock analyzer tool and show what we think the value is, the issue with Intel is there's a lot of threats from a lot of chip companies out there, right? AMD, and this has happened over time. Intel is the leader. Do I think there's going to be competition? Absolutely. When you have margins like that, you're going to have competition. But Intel has the free cash flow to go out there, make acquisitions, and kind of support their market share a little bit. And I also think the multiple is very reasonable multiple with their growing free cash flow. If they're a dying company, everybody worried about Apple. I think Apple was only 2 or 3% of their business, and everybody was like, oh my God, Apple's taking away. Go ahead.
It was 1%.
Was it 1% of the business?
Yeah.
Okay. I just look at it going, remember, guys, in investing, most people take one piece of news and exaggerate it fully to drive down prices. Yeah. Your job as an astute investor is to look at it and say, is this real or is this just an over-exaggeration of what's happened? I think with Intel, this is an over-exaggeration. So we have a stock analyzer tool before we go on to it to determine what we think Intel should actually be selling for. Seth?
Yeah, so if you're interested in fundamentally owning this stock for a long time, that's what Paul's talking about. If you want to trade this on a day trade, momentum trade, weekly trade, 3-week trade, that's where Mo the Great comes in. Mo is the captain of the Patreon tier, the Bid and Ask Nation, where if you're more intrigued by trading, you can follow Mo, his charts, and his rules, and make some of that cheddar. Mo, what are people doing with Intel?
So this is a great looking chart if you are bullish on this company, because right now you got beat down. The company gapped down a little bit, maybe bad news, earnings. I don't know what it was exactly on this date, but it gapped down in price on you overnight. And we can see that on our stochastic right now, we are just on the bottom. The price is slowly declining / staying the same. So the idea right now for this is we look at this stochastic and we wait and maybe grab a tracker share. This would be a great company for you to put a tracker share on. That's one share just to keep yourself more engaged in the stock and see it in your brokerage account every day. And we're just going to wait until this red line crosses into the sweet spot. Then you'll start getting green engulfing candlesticks. This is a perfect tracker share stock. And another reason that I love this is because of this gap. You notice back here when this gap happened, I always say the gaps fill. Stock price came up and that gap filled right back up. This one, same thing. It gapped down, it hasn't filled yet. Eventually this price is gonna go up there and fill this gap. So this is a great looking company. Put a tracker share on it, one share just to stay engaged, and I think you will do very well with this company over the long term.
Yeah, Mo, I was just queuing up my Fidelity right now to get a tracker share on that. To get
Great
my
idea.
account. I think my son would love this company.
I think I'm going to throw a tracker share on myself.
I love that. He loves 8-pillar companies. So, Paul, let's get to this beautiful graph behind you. What is this?
So,
this confuses me. So tell the viewers.
So this is an Excel sheet I created. The good news is for everybody who signs up for Patreon, this Excel sheet is currently being put into our software, not as an Excel sheet, actual part of the software that will tell you based on your assumptions and what you want to make in an annualized return, what you should pay for a stock, okay? So for those of you out there who think I don't care about growth, first thing I look at is growth. So I love when I hear people say that. Over the last 5 years, annual growth rate in revenue has been 6.5%, income growth 13.4%, and it does a lot of different metrics here that you want to understand and look at, including profit margin. One of the things I always look at is profit margin over the last year versus the last 5 years. So in the last 5 years, the profit margin was on 24.7%. Last year was 23.9%. Keep in mind, though, there's a chip shortage now. My guess is profit margins will increase. Not permanently, but there will be a short-term increase in profit margins, just like there might be a short-term decrease. So what we do here is we put our ticker in, Intel. Then I look at the revenue growth, and I want to discount the revenue growth to sit there and give myself a range of prices I'm willing to pay. A discount of 50%, a discount of 25%, and keeping revenue growth the same. Share buyback. Share buybacks are a big thing when it comes to value because as this company is buying their shares back, removing shares from the market, your personal share of the profit and revenue increases. So that should be worth something to you. And then finally, profit margin. Is profit margin going down 20%, 10%, or staying the same? Now down here, net present value is basically the return you want to make on your money. So I'm putting 10% because that's pretty much the market return, and a 15-year future PE. I type all those things in, Uncle Seth, and based on the current data, I have current price is 57. I have the company worth 64 to 106. It's a wide range, but it should be a wide range because I made some assumptions in the middle. Mm-hmm. This is what it'll allow you to do. As you change your assumptions, the price will change as well. So I'm actually a big believer in Intel. I don't think they're going to be worth 64, but I don't think they're going to be worth 106 anytime soon. I think they're worth somewhere in the 80 to 90 range. So my question is, where am I a buyer of Intel? I'm selling puts at 55 and below right now, which is different than a year ago when I was selling puts at $45. So as time has gone on and things have kind of tapered out a little bit, and I've seen what really happens in the chip market, I'm willing to pay more money for Intel because the information has gotten better. So this is what I want you guys to understand when we're talking about values of companies. Everything is just a calculation. Everything's purely input in, outputs come out. That's it. All you're doing is making your assumptions and it tells you what you're willing to pay. It's just math. As an example here, let's change my assumptions here. Let's say revenue is going to go to 25%. Share buyback is going to stay the same. So it's a full, and profit margin just drops 20%. But I want to make 15% of my money, and the future PE is 12 instead of 15. So I want to make more money. Look at my price, $46 a share. So I made all these assumptions that were ridiculous, that were very low assumptions. But that's what the great thing about investing is. If you were able to buy this company at $46 a share based on those awful assumptions, I think you're going to be doing very, very well for a company like Intel. And if they stay depressed in price, what's Intel going to do with their free cash flow? They're going to keep buying shares back. You're going to get more and more of it, and this price will keep going up and up and up.
Great for the shareholder.
So I bought shares of Intel at $44, $45 a share. I'm killing it on those. I feel I'm buying an $80 stock for 45 bucks. Now I feel like I'm buying an $80 to $90 stock for 55 or lower. That's the way I look at it. It's all about assumptions. So when you hear those hype guys talk about this stock's going to the moon, what's the assumption made there? Kathy Wood recently said, if Tesla grows 92% a year, it's a value stock right now. That's her assumption, 92%. That's a ridiculous assumption. I like to go on conservative assumptions and say, oh my gosh, look at these conservative assumptions. I can still make money and still do better than the market by doing that.
If you made it in the video this long, congratulations. If this really speaks to you, you might be one of our patrons in the near future because we have a lot of people talking just like this. we get a lot of haters sometimes saying, "Do these guys like any stocks?" And in this case, Intel, we are loving from a fundamental standpoint and a trading aspect. So it's the best of both worlds. It's Intel, and as you can see how fired up Paul gets about this company, it's just
I just like it a lot. I feel like it's because I really love the fact that everybody just dismisses it. When I see the comments on Seeking Alpha and other websites when they talk about, oh, this company's dead. It's the same thing I heard about Microsoft in 2012. I was literally told by a tech CEO in Cleveland that I was stupid for buying Microsoft stock because that he wouldn't pay $50 billion for it if they had no debt and $100 billion in cash. He literally said I wouldn't pay $50 billion for it. And that's my point, guys. Even these smart tech CEOs are absolutely financially stupid. He literally wouldn't take the company, pay $50 billion, shut down the company, take the $100 billion in cash, get his $50 billion back, and $50 billion in profit. So that's the thing. You have to go pay based on people's emotions. Go make your money based on people's emotions. People are discounting Intel. I would not be surprised if 3 or 4 or 5 years from now, Intel is one of the leaders in the market in terms of stock, because of when the market does turn down and people care about cash flow, where are they going to go? They're also going to all of a sudden going to remember that Intel, during bad times, had increasing free cash flow. Increasing free cash flow along the way. They're going to be like, wait a second, why did we hate Intel? I forget. What happens?
Because there wasn't hype.
Yeah.
It wasn't going to the moon.
But same with Microsoft. Microsoft, I will always use that example because that was the biggest example ever. It was literally the first and only time I ever said this company is not dead, growing 8 or 9% a year. And now it's one of the leaders in the market.
Gently caress that thumbs up on the way out. And we'll see you on the Discord, patrons. You know I love you. Thanks for watching.